Most people think that you need to own dozens of stocks or constantly chase the next big thing to grow your wealth. I don't. My portfolio was made up of just 3 investments, and together they give me growth, stability, and exposure to one of the most exciting industries in the world. It's simple, it's low maintenance, and it frees me from stressing over every stock market move. So stick with me, because I'm going to show you exactly what they are and why they work so well together. So today I'm going to walk you through my personal 3-fund portfolio, the strategy that I've refined over years of trial and error and learning. These 3 investments check all the boxes for me. They give me broad market coverage, long-term growth potential, and strategic edge in one key sector. I'm not telling you to copy it. I'm showing you how I think about diversification and why this approach works for my goals. Hi, I'm Greg Hardy. Welcome back to the channel, and thanks for being here. We cover all things personal finance, investing, and building a secure financial future. If you're serious about taking control of your money and learning something new every week, give this video a like. It helps the channel and gets this information to more people who need it. Thank you. When it comes to investing, I've learned that more isn't always better. Some investors own 50 different stocks, others hold a long list of ETFs. But I found that the more you add, the harder it is to manage and the easier it is to get distracted. That's why I stick to a simple 3-fund portfolio. It gives me the exposure I want without overwhelming me with constant decisions. Simplicity for me isn't just a preference, it's a strategy. With these 3 ETFs, I can cover most of the US stock market while also leaning into areas that I believe will grow faster than the average. This balance means I'm not putting all my eggs in one basket, but I'm also not spreading myself so thin that my investments feel scattered. Every fund I own has a clear purpose, and together they work as a team to give me growth, stability, and target exposure where I want it the most. The beauty of this approach is that it's easy to stick with. When your portfolio is too complicated, it's tempting to make changes every time there's a big headline or a sudden market drop. That can lead to emotional decisions and poor timing. My 3-fund setup keeps me consistent, it's diversified without being overcomplicated, costs very little to maintain, and I can rebalance it in minutes. In short, it keeps me focused on my long-term plan, and that's where the real results come from. There's another YouTuber that I've personally subscribed to, and that's 𝐬𝐮𝐬𝐫𝐞, who runs a channel called Investing Simplified Professor G. He's shared several videos about his own 3-fund ETF strategy and the success that he's had with it. His content is solid, and it's definitely worth checking out if you want another perspective on this topic. Now, let's dive into the 3 funds that make up my portfolio and why I chose them. Let's start with the first piece of my portfolio, and that is SCHG, the Schwab US Large Cap Growth ETF. I have roughly 50% of my portfolio in this fund. SCHG is designed to track some of the biggest and fastest growing companies in the US. We're talking about industry leaders like Apple, Microsoft, Amazon, and other innovative businesses that are shaping the future. When you think of brands that dominate headlines, launch breakthrough products, and set the standard in their industries, that's what SCHG is all about. What makes this fund appealing to me is its focus on companies with strong earnings growth and high potential for capital appreciation. Growth stocks do tend to be a little bit more volatile than value stocks, but over the long run, they've often delivered higher returns. SCHG leans into that potential. It's not just betting on one sector, it includes companies from technology, healthcare, consumer services, and more. But all of them share a similar growth-oriented profile. Another reason that I like SCHG is the cost. Its expense ratio is just 0.04%. And to put that in perspective, for every $10,000 that I invest, I'm only paying $4 a year in fees. That's practically nothing compared to actively managed funds that can charge over 1% a year. Low fees means more of my money stays invested and compounding over time, which makes a huge difference over decades. For me, SCHG is the growth engine of my portfolio. I'm not investing in it for quick wins or short-term speculations. I see it as a way to capture long-term trends in industries that are constantly innovating and expanding, whether that's advancements in AI, breakthroughs in medicine, or new digital platforms changing how we live and work. SCHG gives me the exposure to the companies driving that change, and that's exactly where I want a portion of my portfolio to be. Next up is SPLG, the Spider Portfolio S&P 500 ETF. This is the bedrock of my portfolio, the part that everything else is built around. SPLG tracks the S&P 500, which is made up of the 500 largest companies in the US. These aren't just random picks. They're leaders across technology, healthcare, finance, energy, consumer goods, and more. When you buy SPLG, you're essentially buying a slice of the US economy. The beauty of SPLG is its diversification. Because it's spread across so many sectors and industries, no single company or event has the power to completely derail your investment. Historically, the S&P 500 has been one of the most reliable long-term wealth builders, delivering strong returns over decades while continuing to weather countless market storms. It's not flashy, but that's exactly the point. It's steady, dependable, and built for the long haul. That's why I keep roughly 35% of my portfolio in this single fund. It gives me a solid foundation that I can count on year after year. Another thing that makes SPLG attractive is the cost. The expense ratio is just 0.02%, which is about as low as it gets in the ETF world. That means for every $10,000 invested, I'm paying just $2 a year in fees. It's almost nothing, yet it gives me exposure to some of the most profitable and stable companies in the world. I like to think of SPLG as my stabilizer. While SCHG brings about higher growth potential, it also comes with more ups and downs. SPLG helps to balance that out. When growth stocks hit a rough patch, my S&P 500 exposure keeps the portfolio from swinging too wildly. It's not just about chasing returns, it's about making sure that my portfolio can grow consistently without me losing sleep during market volatility. Last but not least is SMH, the Van Eck Semiconductor ETF. This is the most targeted piece of my portfolio, focusing entirely on semiconductor companies. These are the businesses designing and manufacturing the chips that power nearly every piece of modern technology. Inside SMH, you'll find major players like NVIDIA, Taiwan Semiconductor, Intel, and AMD, companies that are absolutely critical to the digital world that we live in. So why semiconductors? Because every major tech trend relies on them. AI, electric vehicles, smartphones, gaming systems, cloud computing, 5G, none of it works without chips. The demand for faster, more efficient, and more powerful semiconductors isn't slowing down anytime soon. In fact, I believe this industry will continue to be one of the biggest growth stories over the next decade. By holding SMH, I get direct exposure to the companies leading that charge. Now, SMH is definitely more volatile than my other two funds and has an expense ratio higher than the other two funds at 0.35%. The semiconductor industry can experience sharp swings depending on global demand, supply chain issues, and new technological shifts. So I only keep a maximum of 15% of my portfolio in this ETF. It's enough to make a difference when the sector is booming, but not so much that it puts my entire portfolio at risk during the inevitable downturns. I see SMH as my conviction play. It's the part of my portfolio where I'm taking a calculated bet on a sector that I believe will outperform the market over the long run. It's not about chasing short-term hype. It's about owning a piece of the technological infrastructure that's going to shape the future. By combining SMH with the stability of SPLG and the growth potential of SCHG, I get a balanced portfolio that still has room for targeted high growth opportunities. Now that you know why I hold each fund, let's talk about how they've actually performed. Over the past 5 years, SCHG, my large cap growth engine, is up about 115%. That's more than doubling your money in half a decade. Year to date, it's sitting at gains of around 9%, which is a solid return considering the market volatility that we've seen. This performance is exactly why I call SCHG the growth driver of my portfolio. It's consistently delivered over the long run. SPLG, my foundation fund tracking the S&P 500, has also done pretty well. Over the past 5 years, it's up around 88%, and that's pretty impressive for such a diversified and stable ETF. Year to date, it's up around 9%, keeping pace with the broader market. This steady performance is exactly why SPLG is in my portfolio. It gives me reliable growth without taking on unnecessary risk. And then there's SMH, my conviction play in semiconductors. Over the past 5 years, it's up over 240%. That's more than tripling your money in just 5 years. Year to date, it's already up over 20%, showing just how powerful this sector can be when demand is strong. Now, of course, this kind of growth does come with more ups and downs, which is why I keep it at around 15% of my total portfolio. But when it runs, it really runs, and that's exactly what makes it such an exciting piece of my strategy. I'm not constantly changing those percentages. I check my allocations maybe a handful of times a year, usually every 3 to 4 months, and rebalance if they've gone too far from my targets. That means if one fund has a big run up or drop, I'll buy a little more or less of the other two funds to bring things back in line. It's a simple system that keeps me disciplined, avoids emotional decisions, and allows me to ride out market ups and downs without panicking. This mix gives me a portfolio that's both balanced and positioned to benefit from areas that I believe will grow faster than the market average. Now, while I am happy with my current 3-fund setup, I'm always open to making adjustments as my goals and risk tolerance change over time. As I get closer to my long-term targets, I may look at adding another ETF or two into the mix to increase stability and income potential. An example could be dividend-focused funds like SCHG or 𝐽EPQ, which offers consistent payouts and a strong track record of performance. This would give my portfolio a little bit more balance between growth and income as I move into a different stage of investing. Guys, investing doesn't have to be complicated to be effective. In fact, some of the best results come from simplicity and discipline, sticking to a clear plan and trusting time to do its work. My 3-fund portfolio isn't about chasing every trend or trying to predict the market. It's about owning meaningful pieces of the economy, growth leaders, and breakthrough technology, all balanced in a way that fits my risk tolerance and goals. What really matters is having a strategy that you can live with through the highs and the lows without letting emotions drive your decisions. When you simplify your investments and focus on the long game, you free yourself from the stress of daily market swings and can build your confidence in your financial future. This approach has helped me stay consistent, keep costs pretty low, and sleep well even when the market gets rocky. So whether you're just starting out or looking to simplify your existing portfolio, remember that success doesn't require complexity. It requires patience, balance, and sticking to what works over time. That's the power of a focused portfolio, and it's what's allowed me to grow my wealth without the overwhelm. If you're ready to take control of your financial future, a simple, well thought out plan like this might be just exactly what you need. Now, if you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, then check out this video here. And also, please make sure to subscribe. Thank you for watching. I'll see you in the next one.